My name is Martin Barry. I'm the Chief Corporate Treasurer at Latrobe Financial. We are a specialist mortgage lender with a 60-year pedigree. I've worked in banking and finance for 20 years, focusing on consumer products via securitization. I'm very pleased today to talk to you about aged care loans. Moving to our agenda, we will cover some of the background to the topic, options to pay for aged care entry, aged care loans, and wrap up with a case study and some Q&A. So looking at the background, and I'll go through this relatively quickly, we all know there's an aging population, and as can be seen here, in the next 34 years, we will see an almost 40% increase in the over 65-year-olds. And this is the baby boomers maturing. So we should be planning for a major demographic shift. Some have called this Australia embarking upon an era of aging. And you can see here some of the numbers that the over 65-year-olds grow from 3.7 million today to 7.9 million in 2050. In particular, I draw your attention on this slide to the change in the over 85-year-old population, and that doubles in the next 30 years. So this issue is hanging around. It's not going to go away. In fact, it's going to become more acute in the years ahead. Typically, the elderly population is, as we call it, asset-rich, cash-poor, and that reflects their purchase of real estate many years ago, the lack of compulsory super savings, and a reliance on the state pension. Typically, residential property forms a major part of their net worth, and this sector is some $6.6 trillion in valuation, and that's about 4 times the value of the stock market in Australia. Typically, for over 75-year-olds, about 80% of their household wealth is represented by residential property. Looking at the needs of this population as they age, there's the at-home and the aged care need, and about 70% of the over 85-year-old population will need aged care by 2025, with an average age of entry of 83.5 years. This slide caught my attention. It's from the Aged Care Financing Authority annual report, and it attempts to summarize in a schematic the aged care sector. So it goes from entry to screening to assessment to services to the actual entry to aged care. Point is, it's really complex. So people do need advice, people need help to understand the sector. Types of aged care, very familiar to everyone here, at home, respite, temporary care, permanent aged care. What are the costs of the aged care entry? Well, there's the basic daily fee, there is the means tested care fee, and we've been through some of those examples this morning. So that means tested care fee, maximum $245 a day, capped at $26,000 a year. In respect of accommodation, there's the refundable accommodation deposit or the daily accommodation payment, with the RAD being the capital value of the room and the DAP being the daily fee determined by the interest rate set by the government, which is the maximum permissible interest rate, the MPIR, which is currently 5.76%. How do people typically pay for the accommodation cost? Well, I've put up here some of the historical splits, and we can see that roughly 40% pay a RAD, about 35% pay a DAP, and the remainder 25% do a combination, this RAD-DAP combo that's been mentioned this morning. Looking at the RAD amounts, here is a summary by state. On average, we're currently tracking at $377 for a RAD, with some of the top-end RADs exceeding $600,000. And RADs have been increasing. So if we look at the RADs previously, it was $377,000 at 31 May 2016 versus $355 at July 2014. It may be with the government withdrawing some of the budgetary support for the sector that RADs increase further from here on in. So what are the options to pay for aged care? I'll go through 5 options today, maybe variations or some more you can think of, but I'll cover 5. So first one, sell the family home. With the bulk of people's wealth tied up in the family home, there's no particular reason to keep it. It can be an obvious asset to sell to pay for a RAD. There's a couple of issues with this strategy. The family home is a protected asset. We've been through some of those examples this morning. Therefore, a property sale would convert a non-assessable asset into an assessable asset. Secondly, there's often surplus funds. Once the sale has been completed, they'll need to be invested, and that investment capital and the income it generates has negative impacts on the age pension and means-tested care fees. Another option is to keep the family home, but to sell down other assets. For example, shares or other properties. The advantage of keeping the home is that it's capped at $159,000 from a means testing perspective. So keeping the house is going to retain that protected asset. If other assets can be sold tax effectively, then this isn't a bad strategy. Another consideration is renting out the home to produce income. There's some changes to the effect of that income, but that's a part of this strategy as well. A variation on this is to keep the family home and release equity. So if there's a typical scenario where a home is owned outright, little savings or other investments, to use a product to release equity to pay for that aged care entry. This works well if there are no other assets available. The strategy retains a protected asset from the means testing and pension perspective. However, to date, the use of mortgage finance to implement this strategy has been small, and this is due to lack of awareness, lack of providers, complexity in the sector. Another consideration is to rent out the home, as I mentioned earlier, to use some of that income. And there's some changes there, but that can form part of the strategy. Option 4. Deduct the DAP from the RAD. This is a good strategy, but families do need to consider longevity here and the costs of increasing costs of that daily accommodation amount as interest accrues on top of it. Option 5, the family can pay for the RAD or the DAP. If the family is going to go into this sort of arrangement, it's best to formally document the process and be aware that there are arm's length rules in terms of means testing and assessment. So here's a summary of those 5 options. If a family concludes that the best thing to do is to keep the home and finance aged care via equity release, thus maintaining a protected asset, potentially producing income, potentially minimizing the means tested fees, then an aged care loan can be a good option. So, aged care loans. What's currently in the marketplace for this? Well, it's really the traditional reverse mortgage product. And there's a number of providers there that I've put on the screen. Reverse mortgages are highly regulated products, and they restrict the amount that can be borrowed by the borrower's age. The problem with this is that the costs of aged care are largely fixed regardless of age. So the reverse mortgage says at age 70, you can borrow 20% of your property value, and at age 90, you can borrow 45% of your property value, yet the cost of aged care is the same whether you're age 70 or 90. Reverse mortgages are for whole of life, and interest can accrue, and that interest accrual can be a large amount over time. But the products do have protections built into them, this so-called no negative equity guarantee. Current rates are 6.2%, so a bit more expensive than the MPIR, and the fees are typically low. At Latrobe Financial, we were looking at the sector and thought there must be a better way to solve this for people entering aged care. So we turned our minds to developing a slightly different product, which we call the Latrobe Financial Aged Care Loan. We simplified the process to ourselves paying the RAD directly to the facility, taking a mortgage over the borrower's house. When it comes time for the facility to repay the RAD, that comes back to us at Latrobe Financial, and we then cease the arrangement with the borrower. So we've really got a simple product with a mortgage over the house and a charge over the RAD, and a refund directly to ourselves.
Can I ask a question about that?
Sure.
How do you make sure that the RAD comes back to you and not being part of the person's estate, whereas the legislation is
Yeah, so we took some legal advice when designing the product from Gaydon's law firm, and they indicated that if we have a payment direction in place, that the facility can refund the RAD directly to ourselves as the lender. But we have worked with people who've said, no, we're not comfortable with that. You'll have to wait until the RAD goes back to the estate. So, you know, we can deal in either scenario, but our preference is payment direction from the borrower to say, upon myself leaving the facility, please refund the RAD directly to the lender. So turning to the details of our product, we designed a loan whereby up to 50% of the property value can be borrowed regardless of age. This is reflecting the fact that aged care costs are largely fixed. We designed a product of a 7-year term, being shorter than typical reverse mortgages, and it can be repaid earlier than a reverse mortgage. It can be used for breathing space. We designed a loan where interest payments can be made any time, or interest can accrue. We designed a loan with a rate less than the MPIR, currently 5.6% on our product, making it competitive for borrowers. But importantly, repayments are required when the loan balance reaches 140% of the borrowings. The loan can be set up under an enduring power of attorney, and we trained our staff to be familiar with this. We also allow monies to be borrowed to cover minor repairs or renovations ahead of a potential property sale. Lastly, we wanted to achieve some simplicity. Our application form is 4 pages versus a typical reverse mortgage of 15+ pages. And we personally walk families and attorneys through the details. Our loans start at $100,000 and go up to $750K, with larger amounts considered on application. What are the customer benefits? Well, we've outlined here the emotional, financial, and combination benefits. Well structured the right way, the loan can provide valuable breathing space for families during a very stressful time. It clearly allows the family to retain a protected asset, the family home, and has flow-on benefits for the age pension and means testing. Allowing the borrower to potentially visit their home is a valuable emotional benefit that we see of this product. The property can be rented out and generate income, although there's some changes to that. There's other benefits being no fire sale, no interfamily issues around documentation. There's a third party that's documented this borrowing arrangement. There's no family guarantees, and there's the ability to renovate the property ahead of a sale or rental. Just go through a case study of a loan, and clearly some of the details have been changed. But Mrs. Smith, 92 years old, entered aged care in March of this year. Her son is looking after her affairs under an enduring power of attorney. Mrs. Smith receives an Australian and Italian pension. Her property is metro located and valued at $700,000, unencumbered. The RAD for the facility that Mrs. Smith is entering is $450,000, but she's decided to pay part RAD, part DAP. The requirement is to finance a RAD for $250,000 and an additional $50,000 for property improvements, so total borrowings, $300,000. Under our product, the maximum that can be borrowed is 50% of the property value, so $350,000 in this case. However, the requirement is $300,000 or 43% of the property value. We calculate the maximum borrowings, including interest accrual, to be $420,000, after which interest must be paid on the loan. This is around the 5th anniversary of the loan. Because the RAD is not paid in full and there's a daily fee, this equates to $34 a day, and Mrs. Smith's son is covering that fee. So I've illustrated here a chart of the loan profile, and this shows the gross loan balance over time. This is the light blue line, so it's increasing with the interest accrual, and then interest payments are made. The black line is the RAD value, so that's the $250,000. That's constant over time. The green line is the net balance, being the difference between the gross loan balance and the RAD after it's refunded. And the grey line is the property value increasing at 3% per annum. So as can be seen, the net borrowings are a small proportion of the property value, minimising the risk of negative equity for the borrower and their family. If we look at the timeline here, there was entry to aged care 24th of March, then a determination of how to pay, an application received 17th of June, application approved 24th of June, and the loan was settled on the 14th of July. So approval from the Latrobe financial perspective was within a month of receiving that application. Turning to some future trends, the Department of Health publishes the roadmap for the aged care sector, setting out the short, medium and long-term goals, and one of those medium-term goals are new financial products to support consumer choice. And I'm very pleased to say that Latrobe Financial has innovated and is delivering this solution today to the marketplace. Be very happy to take any questions from the floor. Right at the back there. Yeah, that's a good question. So the question was, for the benefit of the webcast, if the borrower reached the 7-year point at the end of the loan. There's a number of options there. The borrower could come to us and ask for the loan to be extended. So we could go for another 7 years. If the property value had increased, that would obviously work very well from the borrower's perspective. The other option would be to sell other assets and pay back the loan. Or the borrower could sell the property and repay the loan. So we're willing to work with borrowers at that point. Clearly, statistically, there'll be a small proportion that reaches that 7 years, and so we'll work with borrowers at that point in time. Yes.
What are the deduction fees compared with reverse mortgage?
Yep. So the question was around establishment fees compared to reverse mortgages. Our establishment fee is $2,500 up front. That's slightly more expensive than traditional reverse mortgages, but our rate on the product is lower than reverse mortgages. So we work out around the sort of 2-year point that borrowers would be in the same position if they took a lower upfront fee with a reverse mortgage and a higher rate, versus ourselves having a slightly higher fee but a lower rate.
So the 2.5 when including legal calculation?
No, so they're on top of that 2.5 as well. Yeah. Another question?
I assume that if part of it funds the rent and part of it funds renovations, that they can actually claim a deduction on a proportion that's for renovations on the interest?
That's a very good question. I don't have the answer to that today, but I'll take that one on notice, come back to you.
Okay.
Yeah, thanks. Any other questions?
The first question. So when the loan reaches 140%, is there wriggle room if people just don't have the cash flow to start reducing that loan?
That's a tricky one for us. We, we'll work with borrowers where we can, but we're very clear up front that interest accrues over that period of time, and we have responsible lending guidelines that we need to comply with. So, that would be a tough situation, but it is 5.5 years down the track. Rachel?
Are there any restrictions on residents deducting fees or charges from the RAD?
So this is if the question was restrictions on deduction of fees for the benefit of the webcast. We don't restrict on our side. So, for example, if a facility did have capital improvement fee or something like that, we would want to know about that. We seek a copy of the facility agreement from the borrower, and clearly that can reduce the RAD amount over time. So we're conscious of that, but we don't place any restrictions on it. Any more questions? Yes?
Is there a restriction on the location of the home? Does that have to be within a certain distance from a capital city?
So we don't have any restrictions on the security property location, but we are cognizant of regional locations where there's small populations. That would typically be reflected in the valuation we receive, but no restrictions. Happy to talk through any borrower scenario, and I've put on the screen here the contact details of our BDM team. Thank you very much.
Well, thanks very much for that, Martin, and I'm sure that if you do have any other questions, Martin will be at the Latrobe stand during the break.